Shares of Lemonade are skyrocketing. On November 2nd, the first trading day after earnings came out, did the company just finally report an unstoppable business model? Results that are showing that everything that it's been trying to do with artificial intelligence and insurance is actually working? I'm Jason Hall. This is The Smattering. We're going to take a closer look at its results and find out if it's true or the expectations were just so low that even an okay quarter was enough to send the stock skyrocketing. Before we take a closer look at Lemonade, though, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link, fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. We're recording this. It's pre-market open on November 2nd after the earnings have come out, and it looks like the stock is going to take that gain and it's going to run with it. Pre-market trading, the stock's up over 20%. Okay, great. What did the company report? Was it just beating really low expectations, or was it a really good quarter? I'm going to share the company's earnings presentation with you and go through some of the key slides. It's always good to remember the company's management's job is to put the company in the best light. So a lot of the things that companies lead with might not necessarily be the most important things at the bottom line if things aren't going well, but they definitely highlight the things that are most important for the company to deliver on. So what exactly did we get in the quarter? So a couple of things. Let's talk here on the left. This is the growth story of the company. Number of customers, right? Up 12%. So that's decelerating. That's not going up as quickly as it had been in the past, but it's still good. Premium per customer up about 6%. Again, that's slower than the premium per customer growth we had been seeing for the company. Add it all up, an in-force premium, the total dollars in good result. But again, it's a bit of a deceleration of growth, but still double-digit growth. Again, $1,719 million in total in-force premium. Let's move over here to the right side. This is a proxy for profitability, gross loss ratio. This is how much of these premiums it's having to pay back to cover losses. And the company's been telling us for a while, the goal is like 70, 75%. Now we go back to the third quarter of 2021. This was the beginning of some troubles when that gross loss ratio was in the 70s, but then would immediately skyrocket and spend most of the next couple of years at very elevated rates. And in fairness, part of that was because of some catastrophic losses, which is going to happen from quarter to quarter with every insurance company. And we'll see their loss ratios move higher. But then once those catastrophic losses are in the rearview mirror, we should see a normalization. Now, 83% gross loss ratio this quarter, big decline from those peaks, which is fantastic, but also just year over year, a trend in the right direction. This is a real positive result. And I think investors should be really happy to see these sorts of metrics moving in the right direction. We're going to talk a little bit about the financial profile, but first, just some top line numbers. Again, that 18% increase in in-force premium. This was a good one. We saw its operating expense decline in real dollars, decline from over $100 million to $98 million. Again, that loss ratio we talked about, gross profit dollars. This is important because as that loss ratio comes down, in-force premium goes up, as operating expenses go down, this number should continue to grow. It was up almost triples, up 100, and that's real positive. Still losing money. This is really important to highlight. Adjusted EBITDA loss was 39% better. But the bottom line loss, net loss, $62 million, that was about a third better. That is a step certainly in the right direction. But again, to highlight that, this has been the thing. I've been talking about this for over a year now. This is really the key thing that we want to see the company continue to get better at, is getting those loss ratios, its underwriting performance consistently headed in the right direction. Last quarter, they pointed out that they thought that the trend suggested that they were making strides. And guess what? The data is backing that up. The data is absolutely backing that up. So they ended the quarter shy of 2 million customers. We talked about that here, that 1.985 million. They continue to add customers. The customers continue to add more and more lines of insurance. Okay, so what do we have? We have still losing money. The losses are shrinking. Gross profit dollars are growing. The metrics are getting better across the business. I want to highlight a couple things about what it all means that I think is really important. The thesis for Lemonade has been disrupting the insurance industry through two ways. Number one is using artificial intelligence through its entire business, using it for people applying for insurance, making those decisions whether to underwrite the insurance, pricing the policy out, using the artificial intelligence in its operations to streamline operations, reduce costs, and using artificial intelligence to help things like process and approve claims. The bottom line is that they've done a great job with AI internally for those internal operations, improving processing and paying claims, and also handling some of the operational side of their business. Done a great job there. The pricing of premiums has been the problem, the underwriting. That's the thing that we're finally starting to see improve as those gross loss ratios are getting closer and closer to the goals that the company has put out there. So we're starting finally moving from 2 out of the 3 use cases for AI in the business to seeing 3 of the 3. But again, that's just one of the 2 things that the Lemonade's trying to do to disrupt the insurance industry. The other thing that they've done that they've had success with is changing the business model itself for where insurance companies, you have competing interests with your customers where you make money, ideally make an underwriting profit, right? You sell the insurance policies for more than you pay out in claims. So you have that underwriting profit that's left over after you pay claims. But then you take the float, which is those dollars of premiums that you're holding while you're waiting for claims to come in to pay, that you can invest. And you make money investing the float too, right? So that means that you have there's a little bit of tension between how quickly the claim comes in and how quickly you pay it. You want to drag your feet. All the economic incentives are to drag your feet, deny claims, all of those things. That's the economic incentives of the insurance business. Lemonade has made changes in its business model to make it harder for the company to delay paying claims. They want to pay those claims out. They've also done things to make the relationship a little better for the insuree. So I have an insurance policy with Lemonade. One thing Lemonade tells me they're going to do is they're going to donate some of the money to charity, excess premiums left over. They're going to donate to charity. And it can be a charity that I choose. That means I have less incentive to overestimate the value of a claim that I file because I'm not just taking the money from the insurance company, I'm taking it away from my favorite charity. So those are some things that they've done that I think are really working well. Lemonade has really high net promoter scores, seems to have really high loyalty. If you look at the retention rate of their customers, they're really high. Those are positive things that say their business model is certainly working. What we've been waiting on is something they finally started to show this quarter, is that gross loss ratio is coming down. That's affecting the bottom line, moving them closer and closer to profitability. Okay, so it sounds like things are moving in the right direction. I think that's certainly the case. Last question, is Lemonade stock a buy? If the stock's going to be shooting up a lot after you've seen this video, did you wait too long? Have you missed your opportunity? I think not. Again, this isn't still a risky investment. The company's still losing money, hasn't completely gotten those loss ratios to the levels that, again, we're talking like mid 70s levels and they're still in the 80s, hasn't gotten those gross loss ratios to the levels that they say are the goals and hasn't shown that it can do that for an extended period of time. So there's still risk here, right? The company doesn't fully deliver on its promises. I think this is clear sign that it's getting there though, and that it has the potential to get there. Whether or not it's too late, if they continue to deliver, absolutely not. At recent prices, this company has a market cap of $1 billion. We're talking about a multi-trillion-dollar industry. The insurance industry is huge. They just got to 2 million customers, and their customers that they have don't do all of their insuring needs with Lemonade. The potential to continue to grow is astronomical for this company if they can continue to deliver. Investors that are thinking about Lemonade as a stock, this is not a good time, I don't think, just to load up, because again, there's still a lot of proving the company has to do, but we're seeing evidence what they've said is starting to happen. I think this might be a good time to add to an existing position or maybe start a position. Lemonade's a perfect company to build out your position over time if they continue to demonstrate that things are working well, and also not leave yourself too exposed. If this quarter that looks really good just turns out to be a false signal and future quarters aren't good, you didn't invest too much, take on a ton of risk in a company that can't really deliver over the long term.